Today, I was joined for a conversation by Professor Kevin Coldiron. Professor Coldiron is a lecturer at the UC Berkeley's Haas School of Business on dynamic asset management and is one of the leading voices in the field of quantitative finance for over 2 decades. In the mid-1990s, he was part of the team at Barclays Global Investors that first began to popularize factor investing. Professor Coldiron ran BGI's European hedge fund business before co-founding his own hedge fund in 2002 called Algert Coldiron Investors. AGI had an exceptional track record and was consistently ranked by alternative investment consultants as among the best equity market neutral managers globally. He recently co-authored a fantastic book called The Rise of Carry, along with Tim and Jamie Lee. This book delves into a very important topic of carry trading and explains how carry trading has grown to dominate the financial markets with serious and not yet understood consequences for growth, inflation, and wealth inequality. And now, my conversation with Professor Kevin Coldiron. I think an interesting topic to start off with is an origin story. It would be great if you could, in your own words, shed some light on how your personal interest in finance began and how your journey has evolved in the industry so far.
Thank you for having me on your podcast. It's a real pleasure. Yeah, for me, actually, the real origin story was my grandfather gave me some, shares in general public utility when I was 12 years old. And I'm so old that back in those days, you had to get the actual newspaper and check the share prices every Sunday. So I remember doing that as a kid, and that kind of introduced me into the world of, investing. And then when I was older and able to earn my own money, then I started buying shares myself. So I was pretty much always knew I wanted to work in finance and banking. And my first job was with the Federal Reserve Bank of New York. And that was lucky because I got to see firsthand how central banks are to the financial system. And I realized I didn't want to be a central banker, but having that experience of seeing how the actions of central banks move markets and how people anticipate their action, and that moves markets, all that together gave me kind of just like a grounding, I guess, in the macro side of finance. Mm-hmm. So after I worked for the Fed for 3 years, and then I went to London Business School, and I started getting, I got a bit lucky in that, in the same way you guys have to do sort of an applied finance project, we had to do the same thing. And my applied finance project was working for a UK bank, helping them develop a model to price interest rate risk, which honestly at the time I was not qualified to do, but I worked with one of the best professors in the finance department at LBS, and that really got me interested in quantitative finance. And so after LBS, I was really focused on working in the not just in finance, but in using quantitative models to help make decisions in finance.
Mm-hmm. Wow. So I guess one thing that would be interesting to understand is you started your journey by taking some inspiration from your granddad. You incorporated it into your life and took on finance as a career right from your education. You moved into quantitative finance, which now it's becoming more emergent, but you were early in this field. So I'm curious, were there any books or people you looked up to back then when you were a student who sort of had a very important influence in the way you perceive the markets?
Yeah, that's a great question, because it was a completely different world back then. And, access to data and computing power was, much more restricted. In terms of books, there really weren't a lot of books on quantitative finance back then. Once I started working, And a few years into my career, so initially I started working for Barclays, and then Barclays, through kind of a complicated corporate transaction, ended up merging with Wells Fargo Nico, who was kind of the leader, the innovator in quantitative finance in the US. And I ended up working for Richard Grenold, who I call him kind of like the godfather of quantitative finance. And he had written this book called Active Portfolio Management, which really goes through the details of how you build a model to forecast risk, and then how you isolate the portion of a return and see if you can forecast that. So basically, it's kind of like, if you think about it from an engineering point of view, it was really how to engineer a quantitative portfolio. And then Richard personally was just a great mentor in that he was a physics guy, so he understood the math, but he really appreciated investment intuition, which honestly is more what I brought, because I was kind of like a competent programmer and I understood the math, but I'm not, I'm not a super quant, but I knew enough quantitative tools to be able to use his framework to test investment ideas that I had. And he was really good at encouraging that.
I'm curious about the most random places that you would draw your inspiration from for your ideas.
So I guess in terms of more creative ideas, I started reading this guy called Richard Dawkins, who's I guess a geneticist, and he'd written this book called The Selfish Gene. And he subsequently became sort of better known for kind of a secular versus religious worldview. But his early work was all about kind of the notion that evolution doesn't take place at the organism level. It takes place at the genetic level. Genes actually fight to reproduce and so on. So I started thinking that model had some analogy in the financial markets, where the individual players were kind of like the genes, and they weren't necessarily, they'll do whatever they could to survive. They'll adopt tactics and ideas and strategies that ensure their survival, whether or not that was economically rational or not. They'll do what they have to do to survive. So basically, I started seeing the markets more as a kind of a game and balance of power between different actors. And some of those themes ended up, we wrote about in The Rise of Carry, like the basically it's about incentives. What incentives do you have? How do you apply them? How can you exert the most influence and power over other people?
Right, and you hit the point on the world we live in. It's like a multiplayer game, which with each individual player having his or her own incentive structure, and it's quite fascinating to see how there's both wisdom and madness in crowds. Like for instance, when there are certain big market events that take place, like for instance the GFC or the COVID-19 crisis, when these big events take place, we see how people come together and behave and react to such an exaggerated extent. I mean, rightly so, of course. I'm not making any politically incorrect statement of why people should not be fearful, but this fear kind of transitions into a quantitative metric by defining the price of companies in the market, which, if the world does not end, like let's say in a month, is going to revert back to normal, right? So it's pretty fascinating to see how there's both madness in crowds and systematic irrationality which can be exploited, but at the same time there are other situations where there's a lot of wisdom in sticking to what the pack says. I guess this is rooted in our own evolutionary process which we have gone through. That is, back when we were all hunter gatherers, it was wise to stick to what the herd is doing. It was wise to see what others are doing. It was wise to be reactionary. But now we've moved into a state where instead of being reactionary, we should be more thoughtful.
So yeah, I think more and more we realize that there are situations where, like you said, the madness of crowds can lead to mispricing either at the individual stock level or at the market level. So there are opportunities for people who can divorce themselves from the emotion. But remember, those are often very, very difficult times to act, like, say, in late March or April of 2020 was a great opportunity, but you had to have a lot of, courage to step in and buy the market at that time, right?
Yeah.
So it's always quite, it's easy to look at a back test and say, okay, when the market falls 20%, it's time to buy or something like that. But actually, when the market falls 20%,
Yeah.
you really don't feel like buying.
I guess back to what Mr. Buffett says, be greedy when others are fearful and fearful when others are greedy. But yeah, very, very difficult to implement in real life. I guess
What I found is, sorry to interrupt, but the people that are successful doing that, being greedy when others are fearful and fearful when others are greedy, have come up with some way to distance themselves from the emotion. So you can have a trading rule that you follow, right? And you tell yourself, I'm going to follow this. And, or the I had clients all over the world, and the ones who were most successful in divorcing themselves from the emotion didn't live in New York or London. They lived in somewhere in the middle of the US where, their lives weren't dominated by finance. And I found those people they could see the world more clearly, because when the markets were panicking, the people they dealt with day to day weren't really paying that much attention to it. Whereas if you live in New York, if you live in London, if you live in Shanghai, and the financial markets are doing bad, that's all everyone's talking about. And so it's more easy to get caught up in those emotions. So you need to find either a rule that you can follow, that you kind of pre-commit to. I am going to do this if this happens, or, try to physically remove yourself from the emotion.
Right. And, this is a brilliant point because two things. So, first, as the world becomes more and more interconnected, and as social media kind of proliferates all our lives, access to information is so easy. Access to the latest headlines it's just going to be flashing in front of you, even if you don't want to physically see it. And in a world like this, dissemination of such good news and bad news happens at rapid paces. So in a world like this, it's really difficult to not be influenced by something unless you consciously choose to do so. And that brings me to the second point of it reminds me of how it's difficult to meditate in a mall, in a crowded place, but it's pretty easy, or at least less difficult to do so in a quiet room. And I guess the same applies to not being swayed by the madness of crowds too in the world of finance.
Yeah, no, that's a great analogy. Find a way to get to a quiet room, and I find it really helps to kind of either write things down, like, okay, I've thought about it, and when this happens, this is how I'm going to act, and go. It's kind of like you have to build your own rules or quantitative models to use in those times, or you can meditate in a noisy mall. Sometimes the thing is to meditate on the noise, right? You focus your mind on just experiencing the noise, and I think you can do it with markets too. It's like, okay, this is what everyone's worried about. Why are they worried about it? What's going on with them? But in some ways, it's still a way of separating yourself from the noise. You can either do it physically or you can do it kind of emotionally.
Right. And I think this would have played really well again during COVID, experiencing the noise and seeing how folks are reacting and why they're doing so. It's usually hinged on deep, primitive emotions within us to save ourselves, to cut our losses. And if we can kind of separate ourselves from the larger crowd and kind of see why they're behaving the way they are, and ask ourselves what is the most objective thing to do in a scenario like this, that can get us a long way without us being absorbed by the noise, right?
It's to tie it to a theme we talk about in the book. It all comes down to what I call demand for liquidity, or you could call it demand for cash, which is really safety, right? So what we all want when things are uncertain is to feel safe. Yeah. And if you can set yourself up from an investment point of view with a margin of safety, so that when things are going wrong, you can step back and say, all right, I'm safe. Mm-hmm. I could lose money in my portfolio, but I've got enough cash that it's not going to wipe me out. Then you're in a position to act with less emotion, right? Right. And that in turn ties to this concept that we also talk about in the book, which is leverage. If you're leveraged, that's kind of the opposite, right? You're borrowing money to invest. And so when things are going well, you're doing extra better, but you're forced to act in a downturn. So someone with a margin of safety like Warren Buffett can take advantage of people who are leveraged, because Warren Buffett doesn't have to act. The people that are leveraged do have to act. Mm. And we kind of see the world now as more and more actors being leveraged. So they're forced to react to the market, which potentially creates more opportunity for those who are in a position to, take the other side of those trades. But I realize it's not always easy to set aside a margin of safety in good times because you feel you're missing out. Mm. But that can definitely help you take advantage of things in bad times.
Right. So switching gears a little bit, let's jump to the story of your book. Before we delve into the actual concepts of the book, I think it'll be interesting to know how you conceived of the idea for the book, The Rise of Carry, along with co-authors Tim and Jamie Lee. Could you also shed some light on why the existing literature was failing to capture this very important notion in its entirety?
So I started a hedge fund business in 2002. I'd run the hedge fund business for Barclays starting in 1999. I set that up and I ran it for a few years, and then I set up my own firm in San Francisco. And Tim Lee ran a consulting company called Pi Economics, and his clients were mostly macro hedge funds. And he would write kind of strategy, like, hey, this is what's going on in the macro economy, this is what's going on in the financial markets, and here's what I think might happen. He didn't really make predictions about asset prices, but more like, in this environment, stocks are more attractive or bonds are more attractive. Anyways, it's kind of funny because neither Tim or I can remember how we first met. We obviously met somewhere, and I was really impressed with his research, and so we became a client. So I started reading a lot of Tim's work regularly, and what he started writing about in 2005, 2006 was something called the yen carry trade. So what happened was Japan had gone through this big, bubble and then bust in the 1990s. And I guess 1989 is when the market crashed. And so the Japanese economy was really going nowhere for a long time. And to try to get things going, the central bank lowered interest rates to basically zero. So it was really cheap to borrow money in Japanese yen. And interest rates around the world back then in the 1990s were much higher, 5, 6, 7, 8%. So people would do the trade where they would buy Japanese yen and they would borrow in Japanese yen, which cost them nothing. And they would invest in, the dollar or emerging markets or securities in Europe that earned a much higher yield. That's a carry trade. So the carry is the difference between the interest they earned on whatever they bought and what they paid in Japan.
Mm-hmm.
So not many people were. So what that's kind of a trade that you're happy to do when things are good, when times are good, but in bad times, when the economy starts to turn down or risk starts to emerge, if the securities that you bought start falling in price, then you need to close out that trade in order to get the money to pay back that what you borrowed in Japanese yen. So what Tim started noticing is that anytime there was risk aversion or people started getting worried about what was happening in the markets, the yen would appreciate. And no one really understood what was going on. And Tim explained that what was happening was these carry trades are being unwound. In other words, reversed. People had to sell the securities. Let's say they had borrowed in Japanese yen and bought US dollars. They had to do the reverse. They had to sell US dollars and buy Japanese yen. So anytime there was a quote unquote risk off market, the yen started doing really well. And Tim was like the first person who really, that I had seen write about this and talk about it as being important in a global context. And so when I started, engaging with him and understanding the mechanics of the carry trade, I started seeing that same dynamic happen in other markets. And so eventually, many years later, when I sold my stake in my business, I called Tim up and I'm like, hey, I think all the stuff you've been writing about with carry trades would make a really good book. And he said, yeah, you're right. And it turns out he had already kind of started outlining a book with his son, Jamie, who was basically a traded volatility. It was a derivatives trader. So what was really nice about the partnership was that Tim is a macroeconomist. He saw the big picture world. Jamie was trading in the volatility market. So he saw the kind of gory details of what was going on day to day. And I had experience in the hedge fund and institutional asset management world. So I knew the incentives and the strategies that were being employed by the big players. And so the book really, I think the reason the book works is it combines those three perspectives together.
Right. A few pointers I wanted to double click on. One, so carry trade is essentially when one entity borrows at a low rate and lends it to another entity at a higher rate. That's carry trade in a sentence.
Yep.
But okay, so this is exactly what your local bank does, right? They lend you. We go and deposit our money in the bank. They give us very, very, very minor amount of interest on what we deposit, but they use that to lend the money to the borrowers at a higher rate, and they make the difference. So this key idea, like how has this how has this concept kind of spread across different parts of the financial markets and in other domains, and what has led to the rise in this phenomenon being spread across different markets?
Yeah, so there's a lot of good stuff in what you just said. So let me try to unpack it. So first of all, you're absolutely right. What banks are doing is a carry trade, and one, I think, people have, I think, interpreted our book, some people, not all, as, hey, carry trades are bad. We're not saying that. In fact, we explicitly say that some level of carry trading is absolutely critical for the functioning of markets and is good for the economy. So banks provide a really useful function, right? You've got money you don't need right now. You put it in the bank. They give you a little bit for that, and in turn, they lend it to someone who needs it. And so that is kind of helps allocate capital efficiently. So there's nothing wrong with that, but that's point number one. In terms of the way carry trades work, I think it's important for all of us, anyone listening, to understand that it's a trade, it's a transaction that makes money as long as the world more or less stays the same. So in the book, we say it's a trade that makes money if nothing happens, right? So the bank pays you, let's say they're generous, they pay you 1% and they loan it out at 5%. So if nothing happens, the world stays the same, they're earning that 4% difference, right? If something happens, if something changes such that maybe the people they've lent the money to can't pay it back, then they have a potential to lose money. So carry trades are really a bet on stability. And in the banking world, stability is kind of what's happening with the economy. Now, when you do a carry trade in the financial markets, let's go to the currency carry trade that we talked about earlier. You borrow Japanese yen, and let's say you pay 0, and you invest in let's say Turkish bond, because we use Turkey a lot in the book. You buy a Turkish bond for 10%. That's a carry trade. You're kind of acting like the bank, right? You're borrowing at 0 and you're lending it out at 10. That's a bet on the Turkish currency staying stable. So if the Turkish currency stays stable, you do really well. But if there's a depreciation in the Turkish currency, then you might not have enough Turkish lira to pay back your loan in Japanese yen. So as the currency starts depreciating, you need to close out your carry trade and pay your money back. So in the difference between that and the banking world is financial market prices are moving every day, all the time. And so you are having to react to that in a way that banks don't have to revalue their books every day. So volatility in the world gets transmitted to carry trades much quicker than it would to, say, the old-fashioned banking carry trade.
Right. I think an idea which I want to move deeper into is, you did make the statement that carry trades are, it's not a blanket statement that carry trades are bad. It's just the excessive amount of carry trading which has its unintended consequences on other parts of the economy that might not be as good for the world. But I do want to delve deeper into the good of carry trade. Like, correct me if I'm wrong, but this strategy is helping cement the arbitrage that exists between different countries in their exchange rates and interest rate levels. And this has been facilitated by external agents like hedge funds, businesses, and other financial institutions. What I'm getting to is this not making the world more connected in some way by increasing liquidity and opening up greater opportunities which might not have otherwise existed if not for the carry trade?
It's a very good point. So let's go back to the example of Turkey, right? Turkish interest rates, local interest rates in Turkey are very high. So if you're a Turkish company, and you'd like to build a new manufacturing plant, or you want to build a new hospital, you want to invest in the economy, but if you had to borrow at 10% to finance that, it might not be profitable. If instead you can borrow at a much lower interest rate, let's say in the US dollar or in Japanese yen, then all of a sudden the whole range of projects that weren't profitable if you have to borrow at 10% become profitable if you can borrow at 2%. So that's your point, right? All of a sudden, the existence of someone willing to take on the Turkish exchange rate risk enhances liquidity, enhances growth in Turkey, right? More stuff happens in Turkey because, people are willing to lend to it. So the growth of carry trades, while carry trades are expanding, and we make this point in the book, economic growth looks great. And in fact, there can be kind of a virtuous cycle in that if you think about what's going on, people are lending money to Turkey. How do they do that? Well, they have to buy the Turkish currency. What happens when people buy the Turkish currency? It goes up in value. So not only are you making a loan and earning 10%, but the currency is going up in value. So you're making the carry, which is the difference between what you're paying to borrow and what you're getting for your loan, and you're making a capital gain. So it seems great. However, you are accepting exchange rate risk. And when there's too much investment and it ends up being unproductive, then you can get the reverse happening, right? You can get companies not being able to pay back, and that leads to a depreciation in the exchange rate, and you can get the virtuous cycle rewinding and have it become a vicious cycle. So the growth of carry trades ends up making the world more fragile in our estimation, especially if the loans that are being used to create carry trades are have to be paid back in the short term. Like in the old days, a bank could make a loan and it would be for 30 years. But in the financial markets, you make a loan. If you start losing money, the person who's lent you the money says, "I want to be paid back right away." So it's a form of liquidity or credit that's not very stable. And so what we see is the world evolving to a pattern of kind of long periods of everything's fine, and then there's some external event happens and these carry trades unwind very quickly and we have a crash. So one of the features of a carry trade is long periods of positive return when the world stays the same, when nothing happens, and then occasional big drawdowns, big crashes, big falls in prices. And as carry trades grow and expand, we start seeing the whole world economy kind of having that same pattern. At least that's our hypothesis, our theory, our belief.
Right. So a couple of questions, so carry trade is essentially when one entity can borrow at a lower rate. Like let's say an investor borrows for a low rate in the US, the world is stable right now, hypothetically, and goes and lends this money in Turkey, which demands a higher interest rate. Now, this causes an increase in demand for the Turkish currency, so that starts appreciating. But what this also leads to is if the Turkish currency increases too much, appreciates too much, it might lead to their export business going down and not being as competitive, which I think ultimately this gets corrected when the impending carry crash inevitably comes about. But what I'm observing is this low interest rate, let's say in the US, it's remaining so for a very long period, mostly because of central bank activity and intervention of external agents, which is causing the world to remain as it is, or volatility suppression is remaining as it is for extended periods of time, more than what is naturally required. And this is causing the periods of calm to get extended and extended and extended. But that's also increasing the fragility that's being built up into the entire system. And finally, it just, in this extremely fragile environment, something like, when the New York lakes freeze up, and if there's a very heavy object that comes and hits the surface, it's just going to crack. It just requires something like that to crack the system, the bubble pops, and that leads to a carry crash. These long periods of stability with a spike or a crash, spike or some sudden event that causes the world to pass the tipping point into a period of high uncertainty and volatility, which causes this whole thing to unwind. But in a scenario like this, I think it'll be interesting to think about how central banks are playing a role in creating this extremely fragile world. Could you go deeper into that?
Yeah, we talk about in the book a kind of a ratchet process. A ratchet just meaning a kind of a gradual development or a buildup. And you can argue whether it started in 1987 with the US stock market crash or 1998 with long-term capital. But let's take 1998. So long-term capital was a giant hedge fund, the biggest in the world at the time. And they had a lot of carry trades on. They borrowed at low interest rates and they invested at higher interest rates. And they were very levered. So that the interest rate differentials we've been talking about are 10% in Turkey, 0 in Japan. Well, they might have been doing trades where they're buying something at 7% and they're paying 6.5%, very small difference. So to turn that into a profit, you have to borrow a lot. So they had very high levels of leverage. Okay, so the Asian currency crisis in 1997, and then eventually the Russian crisis in 1998 caused them to lose a lot of money, and eventually they were, on the verge of bankruptcy. Central banks, they didn't intervene directly to bail out long-term capital, but they basically got all their bankers together in a room, locked the door, and said, "You're not coming out until you sort out a private sector bailout." Okay, so what we saw, I think the lesson that people in the market took from that is that if the central banks are worried about a crisis at a financial institution spilling over into the real economy, they're going to act to provide a backstop. Okay, which at the time everyone thought that was a great idea, and you could argue that that's what central banks are there to do. They're there to make sure that we don't have these systemic crises. It had the unintended consequence, I think, of encouraging people then to do more carry trades once the world had kind of settled down, because they realized that at some point central banks are going to act, and when there's a carry crash, you're not going to lose as much as you otherwise would. So if you want to think about like a distribution of potential outcomes, the really bad stuff, central banks had taken some of that off the table. Okay, so there was a buildup of people doing more and more carry trades, and then it got so big that there was a crash in 2008, and again an aggressive action. This time there was direct intervention to bail out institutions, and so there was another hey, things are bad, but central banks are going to basically provide a floor on markets, so I can do it again in bigger size. And so we view the world as, over time, central banks have kind of become trapped, right? They started by trying to stabilize markets, and now that all that has done is encourage risk taking, which means each time they try to stabilize markets, they have to do it in bigger scale. So now it's kind of if they don't do it, then there'll be kind of an absolute giant crash. So they really have no choice now but to intervene, and the markets know that. So the markets then take on bigger positions, and this goes right back to what we were saying at the beginning about having to view the markets through the lens of kind of balance of power and different agents competing against each other, looking at the other incentives. I think that's kind of a lot of what's happening now.
Right. And I guess one of the key ideas that is surfacing from this discussion is how the world economy is becoming increasingly fragile. We did have a brief discussion about this during one of your lectures earlier this week. But for the audience, I think it would be interesting to double click on the idea of fragility further. Like actions taken by the central banks, policymakers, and other these big influential agents in the markets have led to the world becoming more vulnerable and tenuous. Is this state of fragility that we live in today transitory, or are we aiding the construction of an increasingly fragile world? I guess it's my long-winded way of asking you, what's the end game going to look like?
Well, I really, the honest answer is I don't know what the end game is going to look like. I do feel like that there will be at least one more test of central banks' willingness to support markets. So if you think about what happened in 1998, central banks did not intervene directly, but they organized a private sector bailout. 2008, central banks intervened directly by buying government bonds and some mortgage-backed securities. 2020, they had to do all that plus say we're going to buy bonds of companies, even companies with very low credit ratings. So I think the next time around, everyone's going to expect that they'll support government bonds and they'll support corporate bonds. And then the question will be, will they support the equity market, the stock market? So far, they haven't had to do that because the support they've given to the other markets has been enough to stabilize the stock market. But if we got to a situation where it wasn't enough, then, and this is almost becomes a political question, then I think people say, well, hold on. You bailed out the banks in 2008. You bailed out highly indebted companies in 2020. And now you're not going to, you're not going to help out the individual savers who've been encouraged to put their retirement money in the stock market. Do you know what I'm saying? I think there'll be an enormous political pressure for central banks to buy stocks. And some central bankers, even Janet Yellen, has said that, she thinks the Fed has the authority to do that. So I believe we will have an episode where the markets fall substantially and fast, and the Fed and other central banks are forced to buy stocks. And once that happens, then we're in a situation where it's hard to know exactly what investing is anymore, because there's that we have excessive government involvement in the markets. So I think there'll be one more test, and then maybe people will get together and say, look, this isn't working anymore. We have to find a way to get back to a more free market economy.
Right. I think this ties in nicely to one of the ideas you have in the later chapters in the book, wherein you speak about how capitalism at its truest sense is the idea of creating an environment which promotes healthy competition and free financial markets, intertwined with some regulations which are in place to ensure protection of the rights of institutions and individuals involved. But what we are currently observing is a departure from the fundamental tenets of capitalism and free financial markets to somewhat of a financial corporatism. Could you elaborate on that idea further?
Yeah, if you think about the institutions that are in a position to do carry trades, right? They tend to be, politically powerful banks or wealthy hedge funds, basically the elite, the financial elite of the world. A very, very small segment of society. So when central banks intervene to stop the carry trade crashes from spilling over into the real economy, they end up truncating or stopping the losses of those politically well-connected and wealthy institutions. So that does two things. It reinforces the existing wealth inequality that we have, and I would argue that it reinforces the power inequality, right? It's maintaining, it's acting in the interests of people who are already powerful. And, over time, that starts to become recognized and not seen as fair and not seen as democratic and also not seen as really the market operating the way it should. So, my view is that what the Fed is trying to do with its actions is essentially provide a form of insurance, right? They really, I think, in the end, care about the living standards of the general population. And they're like, okay, we've only got these very crude tools to support those living standards, and they all involve intervening directly in the markets. So it's kind of like trickle-down insurance. It's very ineffective, and it really ends up benefiting the wealthy in society. So I feel like longer term, it would be better if we decide what we want to insure as a society. And I'm using the word "we" here by meaning, like globally, either each country has to kind of figure that out themselves, have that insurance in place, and then allow the markets to operate freely around that, not to intervene in the markets to provide insurance. So whether that's universal basic income, say, everyone gets a certain amount of money each month. So if the markets crash and you lose your job, you won't be on the street. And therefore, the central bank doesn't have to intervene to support companies or markets. And we can have capital then allocated more efficiently. I think you asked a question in one of my classes about this central bank intervention leading to kind of zombification of markets, right? And it was a really good question. I think what you said was, when central banks intervene in the aftermath of a crisis, they lower interest rates. That allows companies that, aren't profitable, that probably should have gone bankrupt, to keep limping along. And sure, in the short term, that's quote unquote good because, people stay in their jobs, but it's a misallocation of capital. Instead of that money being channeled to a newer, younger startup that might be more productive, it gets stuck. So it's an example of doing what you think is expedient in the short term, leading to kind of long-term negative consequences.
Right. I was actually going to go into that question, but thank you.
Sorry.
I guess one thing that I really wanted to highlight from what you said is the problem. The fundamental problem, one of the fundamental problems that we as a society face is not the fact that people have unequal outcomes. The outcome is a function of a person's effort and the person's actions, but the problem is the access to opportunities is unequal. And there are many ways to think about how to go about solving this, right? You touched upon universal basic income. I guess another tangent to that is universal basic services, where you give people the access to basic services like food, shelter, a minimal living standard which is acceptable, and gives people enough utility to go on and be productive with their lives. So, but designing such a model again becomes really difficult as the population of the country grows in size. I guess this experiment has been performed in some Nordic countries. I'm not sure, but let's say testing this out in a country like India, I don't know how it'll play out and the amount of resources that's required, but these are really important questions which have to be thought about in a deeper sense.
I completely agree, and I think we're headed to that. It will just be uneven. It'll take time, and that's what human societies do. We they don't advance in a linear way. We kind of learn over time what works and what doesn't, and we adjust. So, long term, I'm optimistic. I think what we try to write about in the book is the problems with the current system, and those problems might seem daunting or challenging, but until you recognize the problems, you can't solve them, right? So I think it's good that the ideas we're talking about in the book, the problems with central bank intervention, unintended consequences, are now being recognized. And that doesn't mean we won't experience another episode of high volatility or market crashes, but I think that will eventually, hopefully, lead to a more stable system. And I like the ideas that you've talked about, which are similar to what I was saying. Just let's put the floor under living standards that we think is appropriate and that we can afford, and then not interfere in how people kind of compete in the market, because we know that capitalism, it's not perfect, but as an economic institution, it's been wildly successful in raising people out of poverty through time. Right? It really has. And India definitely has an unequal distribution of wealth, no question. But it also has an enormous kind of middle class that's been created in the last 20 years as India sort of integrated itself in the world economy and taken advantage of all its natural, the smarts and entrepreneurial spirit of its people. So let's keep that, but try to, I think, improve in the financial system that we've got.
Right. I think a deeper topic to ruminate over is the contribution of carry towards widening inequality. And I really like the way you and your co-authors poetically touch upon this idea in the book. It's by first linking the concept of carry to something called cumulative advantage. And then you sort of gracefully guide the reader into understanding how carry is synonymous with power. And the way it was written was really beautiful. Could you unpack this deep thought to the audience?
Yeah. Well, first of all, thank you. And I should give credit to Jamie Lee, who really was the kind of main author of that section. So cumulative advantage is just this kind of, we see it everywhere. And it basically means that some initial advantage that you gain in human society, whether it's through luck or skill, tends to get reinforced over time, right? So you have, I think the example we gave in the book, which I really like, is about these famous experiments that were done at Columbia Music, where one group of people get to listen to 20 pop music songs, and they're told, listen to them and just rank them from best to worst. Okay, so they do that, and what they find is that the rankings that the people give had only a very small correlation with actually how many records were sold. So the point is that the records that sold the most weren't necessarily the best music. And then the second group got the same music, and told to do the rankings, but they were given one additional piece of information, which was how many records each one of these songs had sold. So they knew how popular these songs were. And of course, the rankings they produced ended up being much more aligned with the popularity of the song. So the point of the experiment was that anything that happens initially that gets you more popularity will cause other people to, like you more, and you will just build on that. So it's kind of like the Instagram influencer idea, right? If you can become an influencer, you get enough followers, you accumulate power, right? So what we were trying to say is that the people who are in a position to do carry trades, they are the people with wealth and they're people with power, and they may have got to that position, maybe through skill, but it could have just been luck. But once they're in that position, once they're able to, extract the returns from carry, then they can just kind of reinforce their wealth and their power. So it's kind of a long chain, but the point is that these, this notion of cumulative advantage is something that we see really across all aspects of kind of biology and human society. So it's a natural thing. And if we don't want power and wealth to be distributed unequally, we actually have to, take some action against it. It's not going to happen naturally. The capitalist system will not, left to its own devices, lead to an equal distribution of income.
I think a very important aspect to deeply think about is, yes, high sensitivity to initial conditions lead to massively different outcomes in the end. That's like the fundamental nature of chaos. But I guess one thing is by actions of the central bank, intervening and trying to come up with these rectifying actions to keep the market afloat in the near term, it's kind of disturbing the natural flow of things. It's kind of like someone's coming in between the natural evolutionary system and changing the course of things. And I'm curious, of course, the central bank needs to come in to provide some sort of support so that the world doesn't go into extreme chaos. But by it doing this, it's also causing chaos in some other way. So it's like a paradox,
I'm sorry to interrupt, but
yeah.
You're actually doing a better job of explaining the book than I am. And what we say in the book, I think the first page is, why do the markets hang on every word of central bankers like it's the word of God, like it's come down from heaven? Well, it's because what you said, in the short term, they do seem like gods. They have the power to stabilize markets and to change the distribution of wealth. But in doing that repeatedly, they are creating conditions where they'll eventually completely lose control of the system. So we're saying that their current influence is actually masking an underlying lack of power or weakness, and that's being that will be, it's building up. They're having to act more and more aggressively to get smaller and smaller gains, and eventually once the market realizes that they're not able to stabilize in a crash, then you've got a real problem. All that built up kinetic energy really comes out. So we'll see. I'm not, my intention isn't to sort of like be scary or anything. I just feel like that's the world that we've, find ourselves living in.
Right. I think, this provides a nice segue to something I wanted to quote from your book. It's as follows: whether the economy is strong enough to merit an interest rate increase is therefore a question that misses the point. The right question to ask is whether an interest rate increase could provoke a carry crash. So let me ask, given the current environment we are operating in within the United States, could an interest rate hike provoke a carry crash?
I think it could. I think it could, and I feel like we're going to find out in the next 12 to 24 months, because the central banks are going to have to increase interest rates, and inflation in the U.S. is like 7% and doesn't show any signs of falling. So they were willing to allow inflation to run higher than their target for a time, but I think now they're going to have no choice. So we will find out if if that'll provoke a crash or not. And we haven't had interest rates go up yet, although the official interest rates haven't gone up. The bond yields have gone up, and the Fed is still buying bonds. They haven't stopped buying bonds. So really, we haven't seen a lot of tightening, and already the market has retrenched, I think over 10%. So I think it's unlikely the market will be able to handle much in the way of an interest rate increase, which then creates a real problem, because if the Fed isn't able to raise rates enough to cut inflation because the market is falling, then they're trapped, right? Either they have to accept higher inflation, or they have to accept a much lower price for the stock market.
Right. Now, speaking about the unintended consequences that the central bank has on the financial markets, I'm curious how, an introduction of a new character into this whole play, that is the cryptocurrencies and the world of decentralized finance. Do you think decentralized finance will also experience similar phenomenon of carry trades and the volatility suppression that it brings? Do you think we can extend this idea into that world? Just to get your thoughts.
So I think that, there are carry trades you can do in the cryptocurrency market. I'm not an expert, but I think there's a lot of people doing carry trades. Personally, I don't think there's anything wrong with that, because it's a market that's completely unprotected by central banks. And in fact, I think central banks would be very happy for them to crash. So to me, I don't see an issue with that, in the sense from a free market point of view. That seems fine to me. Now, and I think crypto markets have benefited tremendously from central banks intervening and creating a lot of excess cash, excess liquidity. So a lot of that is just flowing into speculation in the crypto markets. When central banks start to reverse course, raise interest rates, reduce the amount of cash, I expect that crypto markets are going to contract substantially. But I think they have a long-term role in the world. They have potential to, make some sorts of financial transactions more efficient and less costly. But that's not what they're doing right now. I think mainly right now they serve as a kind of a bit of a casino. So I think you'll probably see a lot of the crypto market disappear in the next tightening cycle, and then it will rebuild, I think, more along the lines of what its originators had hoped, as a way of kind of improving financial market efficiency. And I think that the other element of crypto markets is there is a concern about, there's been so much money printed by central banks that those currencies are going to lose their value. So let's put money in Bitcoin, where there's a limited supply, and long term it will retain its value. I don't believe that story, but I think, that doesn't matter what I believe. As long as enough people believe it, it will retain its value. So I think some people see it as a hedge against extreme monetary instability. And I guess I am suggesting that we could have a period of extreme monetary instability. So I wouldn't be surprised if some parts of the crypto world retain value because they're seen as a safe haven. Bitcoin in particular, although I personally don't think it is long term, but can be perceived as that.
When an asset class becomes important enough, its correlations increase with the rest of the market. And we saw something similar in a chart you showed in class where, even the crypto, specifically the Bitcoin volatility, it was following a similar pattern as of the S&P 500. And that's really interesting, right? Like, as greater adaptation leads to the behaviors of the market kind of converge. What do you think about that?
Yeah, I agree. I mean, I think that's ultimately, we talked about this in our class, right? Ultimately, all assets are there to, hedge or to finance some future spending or liability, right? That's what you do. You like, I've got some money that I don't need to spend now, so I'll buy a stock or a bond or I'll buy Bitcoin, and then when I need that money, I'll sell it. So the demand for money has the potential to tie all assets together, right? Because people, if all of a sudden people decide we're really worried, I want my cash now, they'll sell whatever they happen to own. So whether that's commodities or stocks or bonds, it doesn't matter. In a world where people want to have cash now, they want to have safety, all these assets are going to be tied together. So you get markets like Bitcoin that start off as being kind of a small, almost a sideshow, that really they shouldn't have any fundamental link to U.S. equities, right? I mean, U.S. equities are driven by the profitability of U.S. companies, and Bitcoin there's no cash flow to it. So it's like, why should they be correlated? And for a long time, they are seen as uncorrelated. But as the market matures, more people put money into it, then it becomes a potential source of liquidity in a crisis. And that gives it the potential to have a very high correlation with the S&P 500. So yeah, as markets become more integrated, they become more correlated. We see that with the Indian stock market used to kind of have almost no correlation with the U.S., and now it's probably like 60% correlated. And India is not even that integrated into the global market system. It's still difficult as a foreigner to trade Indian stocks, yet the correlation is very high.
Right. Right. And I think that's an interesting point you touched upon. I guess this ties back to the behavioral story, right? Something happens in the US market, and then you observe the Indian markets are reacting, or at least showing the similar direction of uptrend and downtrend, maybe not in the same amount in value, but maybe it's just emotions driving the market at some level, which is manifested into various institutions. And speaking of that, a comment I wanted to make about, cryptos being more integrated into, or being more intertwined with the reactions of the general traditional financial markets is, I guess it's one of the first times where retail investors have had the chance to, be the first movers into innovative product in the field of finance. Because usually when some innovation comes up, like let's say securitization, it was first the big institutions that stepped in and took advantage of it. And usually, these benefits are not passed on to the retail investors. But here, for the first time, retail investors are making their big move. And this again kind of ties me back to a comment you had made earlier this week during the guest lecture with Hari Krishnan. Is it possible for small players in the market to use leverage and behave like big players? And I guess we will see, but I guess they do, especially in the crypto markets, right? Retail investors have had the first moving advantage. What do you think about this? And leverage, it doesn't just have to be monetary leverage. It can also be a sense of community that exists within the decentralized finance industry. I guess leverage can be people coming together and believing in an idea, which is something we saw during the GameStop bubble going up and then crashing again. So what are your thoughts about this?
You raised a couple of interesting points. First of all, I guess I might differ from you in saying that retail investors have had a first mover advantage into crypto. I mean, certainly they were in crypto before institutions, but whether or not that's an advantage, I'm not so sure. Like that it's, I've done some crypto trading myself, and you have to pay a lot to move your fiat into crypto, right? It's not cheap. So these decentralized or these crypto exchanges, they're very profitable because they're charging you 1.5%, 2% for something that costs them virtually nothing. So I think the first mover advantage is really in the people who are able to extract those transactions costs. But to your second point about leverage, I think that's quite interesting because the adoption and the spread of crypto has really forced central banks to react, to consider creating their own digital currencies, and has forced institutions to look at kind of adopting kind of blockchain technology in the way they behave as well. So that in that sense, yeah, they retail has kind of used their combined leverage to force existing institutions to react to them, which is quite unusual. So I agree with that point.
With this, I think it provides a nice segue to actually come to one of the final questions of this discussion is, what, in your opinion, are the 3 big mega trends we need to look out for in the coming decade?
Oh, that's a good one. Okay, so I think the first one is how much inflation is going to be associated with the transition to a low carbon economy, right? So that's something that I think most people want, to transition to renewable power. But that's going to involve costs, potentially significant costs. And how much of that is society willing to endure? So how much inflation is good? And I don't know the answers to this. I'm just saying, I think that's like, we really need to how much is it going to cost to transition to a low carbon economy? And are we willing to pay that cost? I think that's critical. Will the existing, so that's trend number one. Number two, will the existing independence of central banks remain? Because if you follow the logic of the things we've been talking about, central banks have become more and more entrenched in supporting the market. Why? Because they don't want bad market conditions to spill over into the real economy. Eventually, that basically becomes a political thing where the government just says, yeah, you have to intervene. And I think we're already pretty close to that. So I suspect the era of central banks being independent of central governments is probably already over, but it's going to end. And then what does that mean? Does that mean that we lose faith in the currencies issued by central banks because they're no longer independent? In which case, is there a crypto alternative, or is there some other monetary arrangement that's going to replace that? I think that will play out over your career. I don't know about mine, but that will happen. So I think we'll see in the next 20 years kind of a rethinking, a reorganization of monetary kind of monetary regime. And then kind of linked to my first point, but it's just, ESG, is it achieving its goals or not? Right. So ESG is what social environment and social governance, basically trying to embed social values into investment decisions. And I'm not saying that's a good thing or a bad thing, but I think it's been promoted as a kind of win-win situation, right? You have an ESG mandate and you're doing good for the climate and you're going to earn higher returns for your investors. I'm not convinced that's right. And so I think there's a huge amount of momentum behind ESG, and people are going to start questioning, is it really a win-win? And people might still want to do it whether or not it's a win-win, because they might think it's good for the environment. But I think they'll even question whether or not it's good for the environment. So what direction environmental and social governance investing takes is the other megatrend I would look at.
Right. A lot of deep thoughts to ruminate over, especially the fact that, with ESG investing becoming more and more widespread, which is good. It's really encouraging to see that pattern has been emerging both amongst clients and institutions alike. But usually when things like this happen, it also leads to bubbling up of various companies and institutions which want to take advantage and exploit this movement, and it leads to something called greenwashing that's been happening, where companies say they're green but they're not actually doing the right stuff. And I guess for things, big ideas like this and important aspects like this in society, it takes a while to be true. It spreads first, you have all the weeds come out, then we have to hypothesize of how to get rid of the weeds, we put in our fixes, and again more bugs come up and we debug that. So it's like a continuous debugging process, which we need to invest time and effort in, because we're not going to get a second planet, so we need to do our part. So I think that's a very, very interesting thought to close on.
That's great. Yeah. And I'm actually optimistic. I think that we always underestimate our innovativeness, our creativeness. And I think there'll be technological solutions. Not that we can't just sit back and expect it to happen, but if you look at what happened with COVID, right?
Right.
It kind of blows my mind. Within 12 months of this new virus emerging, we were able to produce vaccines and then start distributing it around the world. Now, I know that distribution hasn't been equitable, but it's pretty amazing what's been accomplished by science, working with the capitalist system in the last 2 years to solve an existential problem or a serious health problem. I think that's an example of what we can do with climate if we can get everyone sort of pushing the same direction, which eventually will happen, I believe.
Right. I guess it's about, merging the incentive structure with capitalism.
Exactly.
Yeah. So I think this would be a nice point to close this discussion. Thank you so much for taking time out and joining me today. This was a really, really interesting conversation, and I think we took many parts to think deeper about. And thank you for leaving us with the 3 big ideas to think about and ruminate over. Thank you so much.
No, my pleasure. Really enjoyed it. Thank you.